Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending September 22nd, 2023. Appreciate you all tuning into this channel, liking and subscribing, as well as our podcast InvestTalk. I'm host Justin Klein, and today I'm going to title the video Hawkish Fed Feeds the Bears Higher Rates. And it was Fed week. They did nothing as expected for the current policy rate. But moving forward, they did shift their expectations for rate cuts next year and the potential for a rate hike this year. Now, what's interesting about this is I believe their average rate for next year is them around 5.1%, so slightly lower than where we are right now. However, and that's up, I think it was from around 4.6, 4.7 was the average estimate during the last Fed meeting. So clearly they're seeing economic strength and they don't think they'll need to cut rates too dramatically next year. Now, so far this year, they are the median dot plot is for a 25 basis point hike by the end of the year. Now, there's only two more Fed meetings this year. So the one in November 1st, there's only a 26% chance that they'll raise in that meeting, and then a 38% chance that they will raise. Well, I guess if you combine these, that would be somewhere in the 44% chance they'll raise in December. So while they're saying 50-50, the market's still saying, I don't think so. Maybe, but I don't think so. I think they'll pause. So that's kind of the second now 55-45 that there will be one more or potentially two more rate hikes this year versus a pause. Now that is down from where we were a week ago. You can see that here it was more of like a 60-40 proposition. So it didn't move a whole lot when it comes to this year. But next year is where it moved, I think, the most. Okay. So if you look at it remaining at where we're at now in June, that went from 31% up to 37%. Okay. So, and the chances of cuts dropped from 17, two cuts by June to 10, one cut, 36 to 31. So that's really what was the most hawkish. It's like it was not necessarily about this year that moved in a minor way, but what moved majorly was, hey, we're going to be higher for longer, and the bond market adjusted. So we'll dig into those charts here in a minute, but I'll touch on the economic news, which there wasn't a whole lot of economic news. Monday, you had New York Business Leader Survey that was negative for the first time since June, but it's been negative for a while. That's kind of been known. Building permits were up. Now that's permits, so it's planning to build, but actual housing starts were down 11%. So that's the second month out of the last three where housing starts were down over 10%. And so obviously that feeds into builder confidence and supply of new homes, and that's what they need. We need, to get the housing market into more balance, you need more supply homes, and the home builders are not following through, at least over the past few months. So, is that because of confidence? Is that because of maybe financing costs to build these projects, etc.? I don't know, but obviously that is a potential for the economy to be weaker going into next year if the home builders are not hiring as much. Maybe they're laying off workers, and that tends to lead the unemployment rate. And what you can see here is the other big piece of data was on Friday, and that was the initial jobless claims. 201,000, the lowest level. Let me zoom into the 1 year chart, the lowest level since January. And so it's another indicator for the Fed that, hey, yes, the economy's not amazing, but the labor market remains relatively tight. And it's one piece of data. We'll get more data in the next couple of weeks. Obviously, we get the September jobs number week after next, and that will probably be the most important one, especially after kind of a weak first half of the year on job creation. Unemployment claims are interesting, but they're ultimately not the best piece of data. Let's just say that it can be noisy, and how much jobs are actually being produced in the economy, I think, are more important than the unemployment claims. So something to think about. All right, let's dig into the charts here. I'll run to the S&P. We did get a pullback on the Fed news, pretty decent pullback, made a lower low here. And what you can see is we are now in a minor near-term downtrend, a minor near-term downtrend. Now we are into a bit of support around these levels. I think we could go a little lower. What I'm expecting is what happens with these pullbacks are often you get three surges lower. And so we had that first initial sell-off, had a little bit of bounce, lower high, and now we're having the second sell-off. We'll likely get another one, another rally, maybe around month end, maybe next week. My guess is it does start next week. And then you get another rollover into, mid to late October that kind of ends this corrective period before you get into the seasonally positive holiday season. And right now is seasonally negative. August, September, October, usually the worst times in markets. And when you come into it with an overbought situation, slowing economy, a hawkish Fed, it's a recipe for a correction that is natural. Okay. Nothing to run for the hills on, nothing is breaking in a big way. But you're in a corrected period and you have to be mindful of that. Now here's the 10-year, did break out to 16-year highs. So hit about 4.5% before pulling back here on Friday, 4.438%. Obviously, that feeds into higher borrowing costs across the economy. The bank stocks not doing well. Here's the KBE. That's why I've said I don't love the banking industry right now just because of that potential for higher rates. They have a lot of duration risk. You saw that with Silicon Valley Bank. It's pressuring deposit rates, what they have to pay for deposits, etc. So just some knock-on effects there. Anything that's interest rate sensitive, like the banking industry, is going to suffer. Even if you go with XLRE, this is the REIT ETF. Obviously, that is taking out the chin as well. Now, the dollar. What's interesting here is the dollar is strong this week, but it's not really taking off in a big way. You notice that? It's it's barely up over the past week. And that's of note to me. The fact that the Fed was so hawkish, you had the ECB pause, Bank of Japan didn't raise rates like there was or hint at raising rates, and which was kind of talked about. Here's the yen continues to be weak. But the euro weak, but not crazy weak, right? Didn't actually made a higher low here. Okay, FXE. So to me, that's the one tell that this is not breaking anything. Along with, if you look at the move index ticked up, but still around the 100 level. That's not a lot of stress. Even the VIX moved up, but we're at 17, highest level in since mid-August, but we're not breaking out. Certainly could, and we'll probably see I would say low 20s before this corrective period is over for the VIX. But if you look at the credit markets, they're all in there. Here's short-term junk bonds to short-term treasuries. A little bit of sell-off here, but not breaking any lows. Certainly kind of weak, but this is not having a major sell-off that you have to be worried about. So I want to highlight those because there's a big difference between a true rollover in the market and a corrective period. And I continue to think we're in just simply a corrective period. And you can see that too with commodities. Here's the commodity index down the last couple of days, but overall, this is in an uptrend. There's USO, so WTI strong, a little bit of pullback, but nothing crazy. BNO, Brent crude, same thing, very strong. You have uranium, very strong. Here's the URNM. That's very strong. So the energy commodities are doing very well. But you are getting some sell-offs in parts of those industries. So here's XLE Energy did get a bit of a sell-off despite energy prices uh, remaining robust. Okay, UNG natural gas getting a little bit of tick up here, but that's probably the weakest part of the commodity space. Let's see what else. let's look at the basic materials. That had the most sell off here, but you're still just in this kind of range, and that's very neutral. Silver to gold ratio, that did have a nice move higher, especially on Thursday. Still in this range, this kind of wedge pattern, to see which way it resolves. Try to resolve to the upside and failed. Try to resolve to the downside and failed. So, overall, it's still kind of wishy-washy in its signal. If you let's look at the junior miners to the GDX, and that's probably the most negative, is that this is, pulling back dramatically, but it's not breaking new lows, so that's of note. Let's go to ARC. I want to show you this. Let's go ARC to the Qs, because what you think of ARC as the riskier version of the Qs, right? And what this is showing to me is that the Ponzi economy is still weak. And when I say Ponzi parts of the market are, these are companies that spin a great story, whether it's AI, whether that is crypto, whether that's some great software, whatever it is, during the 2020, 2021 timeframe, you could issue shares. Didn't matter if you were losing money, didn't matter if your cash flow was deeply negative, you just issued more shares. And those businesses, and ARK owns a lot of those businesses. Whereas the Qs, those are the bigger names, right? The Apples and the Microsofts of the world, and some of those are weak. Right? Microsoft's particularly been weak. But my point here is that it's still a transition away from those high multiple stocks that don't have a business model, that spin a great story, and those are rolling over. Look at Nvidia is really starting to lose its momentum. I saw a stat about how money or retail money going into AI stocks is the lowest level in like 6 months. So, the average person is pulling money out of these things. Here's AMD, another kind of darling within the space. Even like AI, right? C3 AI, right? The best ticker symbol for AI. That one is now below the 200-day moving average. So it just shows. Oh, let me show you the growth to value ratio. I love to talk about that, and that did start to get some weakness. And there's no major breakdown here, but what you can see, this is a topping pattern. Look at the MACD. Look at the volume, especially on the IWF. This is where the volume was. IWF. Look at that. It's a lot of selling. Why is that? The growth side of the market getting a lot of selling. Here's Von V. This is the value side of the market, not getting a lot of selling. Still weak, but starting to outperform the value side, or sorry, the growth side of the market. So that's the transition that we continue to see, that growth side fading, especially those crappy stocks that don't make money. The larger ones, the Googles of the world, they're hanging in there, right? A little bit of sell off the last few days, but they have good balance sheets. They're earning money on their cash for once. Whereas, if you have to issue more shares, issue debt at a high cost, like that's weighing on your business, weighing on shareholders, and those businesses are continuing, or the stocks continue to struggle. And that's the trend you're likely going to see going forward. As long as you see commodity prices continue to remain strong, this is going to hit tailwind for inflation, tailwind for higher interest rates, and a tailwind for hard assets, right? Your energy and basic materials, your industrials, uh, those type of names, your value side of the market. The biggest thing weighing on the value side, I think, are just the financials. I don't think financials generally are that great. Insurance companies, maybe, but banks are struggling because they just have locked in a lot of fixed rate assets in an inflationary world, which is not what you want to be doing. And so they're managing out of that, but it's going to weigh on a profitability. And so, you much rather be in, the XLEs of the world, despite the pullback. So that's kind of where we're at. Let's go to the NYA, NYC. Similar pattern here. You're going to find some support right at about 1465. So it would not surprise me to see a sell-off the first couple of days of next week, and then before that next rally, and then another leg lower, and then seasonally positive period into year end. So that's kind of the expectation in our minds. Obviously, things could change. The Fed being hawkish hurts asset prices in general, and but there's just a lot of government spending out there. It's keeping inflation robust. It's hard to have a major market sell-off if inflation's in 3 to 4% range, because a major market sell-off is a deflationary bust. There's not the recipe right now for a deflationary bust because of the spending, because of the household balance sheets being relatively strong. Now, government balance sheets are very strong, but that's probably a story for another day. For now, it's fine. The Fed has control of the market. The move index is fine. One day that'll change, but today's not that day. So, well, everyone wants to fearmonger and say everything's going to hell in a handbasket. This is a corrective period that we are in seasonally, and that's how you treat it until further notice. All right, appreciate you all for tuning in. And a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.